Hello and welcome to The Pitch. I'm Sarah Allen and today I'm joined by Resolution Capital's Sarah Lau. We're going to be discussing the global listed infrastructure space, the outlook and key drivers. Sarah, welcome.
Thanks for having me, Sarah.
So to begin with, what is the size of the global listed infrastructure space and what are some of the assets that sit in it?
So the global listed infrastructure space is a very large and liquid opportunity set, roughly $3 trillion in market cap, and that's mostly in developed markets as well. So these companies are underpinned by real assets, and we're looking at utilities such as those in water, gas, electricity. We're looking at transport infrastructure, so railroads, toll roads, airports, ports. And we're also looking at telecommunications infrastructure, so that's mobile network towers and fibre. All of these assets are critical to the economy. They provide essential services and they have very, very strong pricing power. So what this means is that over the long term, they have cash flows that are not really impacted by the economic cycle, but they do benefit from really long-term growth trends.
How has the space been affected by inflation and rising interest rates? Are there certain segments that perform better in these sort of conditions?
The global listed infrastructure space sector was impacted by a change in interest rate settings. What we saw when interest rates bottomed, it was in August 2020 at about 0.5% for the US Treasuries to almost 5% in the US 10-year Treasury, in October 2023. During that period, the sector generated 2% positive total returns, but it's significantly underperformed general equities, which generated 6.5% during that same period of time. When we look at valuations across that time, the impact is actually quite limited because these assets actually, in aggregate, tend to pass on inflation. And the mechanisms which they do this are either contracts, so they've got contractual increases every single year through regulation, or sometimes it's a bit more indirect, and it's because they've got such strong pricing power, they're able to pass through these inflation impacts to the customers. What this means for us is that when we saw inflation pressures, we tilted the portfolio towards sectors which had faster and more pass-through, so sectors such as UK utilities and toll roads. Now that we see that inflation seems to have peaked, we're selectively positioning in sectors such as mobile network towers, which don't actually have very much inflation pass-through, but we feel that valuations are now reflecting the current higher interest rate environment. So over the long term, there's very good inflation pass through the portfolio. We think that the portfolio, about 87% of it is hedged to inflation, and they really benefit over the long term from economic growth drivers.
What are some of the key themes and drivers that you're watching for the portfolio?
So for our portfolio, the key themes are decarbonisation, digitisation, and mobility. These trends are really driven by the changing needs of society, and there's significant investment needed to cater for this. And there's a huge role for private capital because the needs are so huge and government balance sheets are really stretched. So we think that because of how big these needs are, the returns generated should be quite reasonable. For decarbonisation, there's a huge push towards that. And it's really driven not just by policy, but also from economics. So in a lot of places we see globally now, the cheapest form of electricity generation is actually in solar and onshore wind. What this actually means is that there's a lot of investment up front in order to build these things, but then when they operate, it's almost free. So we have stocks such as Dominion Energy, which is an electric utility that benefit from these investments. Another, trend which will benefit Dominion Energy is digitisation. And the way that Dominion Energy benefits here is really from the need for more power And here it's really driven by the AI data center hungriness of how much electricity these things consume. Digitization also benefits communications infrastructure. So very classically, we see mobile network towers and also fiber assets benefit from this. And the last trend that we're watching in the portfolio is mobility. So that's the movement of people and things. So we have portfolio holding for OVR that benefits from that. And it's really long dated trend. It's driven by population growth, urbanization, and the change in supply chains really, with more recently nearshoring. That's really going to drive these assets over the long run. So what we're seeing across the portfolio and across this space are really long-term, economically resilient drivers that will benefit these stocks and companies over quite multi-decades, really.
What process do you use to identify infrastructure investments for the portfolio?
So what we're trying to invest in is core infrastructure, and what I mean by that are hard assets, which are monopolistic. So we really like that they have extremely strong barriers to entry, so it gives them very, very, very strong pricing power. They provide services which are critical to the economy, so you don't get that cyclicality in cash flows when the economy moves up and down. And then the third thing that we like about them is that they benefit from these mega trends that I outlined earlier, but there's some other ones as well. So in trying to get that, we tend to look for valuations and cash flows and earnings rather than revenues. We do have a benchmark, so that's the FTSE Developed Core Infrastructure 50/50 benchmark, but that doesn't dictate what we invest in and what we consider investable, because benchmarks tend to focus on revenues, and we find that it doesn't really match what we want to achieve for our investors. So we can invest up to 20% of the portfolio outside of the benchmark. And in terms of valuation, we have a very disciplined framework. We really focus on an underlying bottom-up basis, the cash flows and the risks of the assets that these companies own. We look at multiple valuation metrics, such as including multiples and also discounted cash flows. One metric which we do like a bit better than others is internal rates of return, which is really our forecast on average over the next 5 years, what the total return would be. So ultimately, what we're trying to do is to identify the underlying assets that benefit the most from these themes, and we're not really just investing in the themes.
You mentioned Dominion Energy earlier. Can you share another example of an investment that you've got in the portfolio and why you chose it?
We like stocks that have quality assets, so the ones that benefit in an outsized way in capturing some of the trends that we talked about. We like very strong balance sheets, and we like solid management with skin in the game. One name that we do like is National Grid. Post a recent equity raising, they're very well positioned to generate between 6 to 8% EPS growth, and we think they can do a little bit better than that. And they also have a dividend yield of just under 5%. So National Grid is a UK electric utility. It owns poles and wires, and we think that the growth here is really accelerating because the UK government is really keen on accelerating decarbonisation. So they want to accelerate and decarbonise the entire electricity sector by 2030. That's a huge task. It requires a lot of investment, and National Grid is a very low risk way of capturing that. Another name we like is Union Pacific. So that's a US railroad. We really think that the medium-term movement of freight within the US is underappreciated because there is a lot of investment in nearshoring. A lot of these are still being deployed, but over the medium term, the freight movements within the US, and particularly between US and Mexico, is underappreciated. And we think that it's really well positioned to accelerate EPS growth into the double digits. So what we're trying to capture in identifying these names and stocks that we like is really the most upside over the next 3 to 5 years with the least amount of risk possible.
Thank you for sharing your insights on this today.
Thank you, Sarah.
If you've enjoyed watching this interview, please subscribe to Livewire Markets. Thank you for watching.